Welcome to Centennial Advisors. We use our cutting-edge technology and collaborative client-focused brokerage team to provide the highest level of professional service at all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisors, here for you now and always.
Good afternoon. I'm Justin White, Managing Director of Centennial Advisors, and it is June 7th, 2023. Usually joined by Jason Brooks of Buckhalter. He's had some daddy duty responsibilities that he gets to attend to today, so lucky him. I have the good fortune of being joined by Tom Watkins and Mike Alper of Centennial, and we're going to talk to you a little bit about what are the real estate headlines, what's happening in the news. We hope you remember the date and look back on this webinar a year or two down the road and see how well we did about talking about where we thought the market was headed and some of the key things that were facing owners in the months ahead. We're going to get right into it and start with some questions. And the first thing that I'm going to ask both of these gentlemen is, what real estate headline is clickbait out there today, Tom?
I'm going to have to go with, every time I'm reading Apple News at night, it's distress in commercial real estate. Distress is coming. Is it real? I do think it's real for most of our clients and for us as brokers. I don't think that we're selling $300 million office buildings, so I don't think it's going to be, it's going to affect us as much as what the papers are telling us.
I can give you a couple stats to support the opinion you had there. Currently, CMBS delinquency is only 3.62%. It's across the country, across all the major product types: office, retail, industrial, hotels, and multifamily. And we know that COVID has basically killed the downtown office, and we're only at 3.62%. For 2 points of reference, multifamily product, which you guys do a lot of business in, is 1.46% of CMBS loans are in delinquency. And the high, the recorded high of the last cycle was July 2012, where over 10% of properties were in delinquency. So I think, Tom, to your point, we read it a lot, we see it a lot. It's definitely in the headlines, but the reality is maybe for most products, operations are okay.
I agree.
Mike, what about you? What real estate headline do you see as clickbait?
For me, I see certain companies advertising really high, really attractive cap rates. And a lot of the time, the expense ratio in their underwriting, it's just not based on realistic numbers. So some of the common things I'm noticing are not accounting for the new property taxes, not accounting for professional management or on-site management, leaving out maybe some of the maintenance numbers, and not really looking at how much insurance costs right now. So I'm seeing really high cap rates advertised that maybe the underwriting needs a little bit of help, maybe a second set of eyes to really ground it and figure out where these buildings are actually operating at.
It's interesting right now in the market is that I would say that, yes, there is an attempt to be really optimistic in the underwriting. But I would say, as somebody who's been in the business for 20 years, where buildings are operating right now is pretty healthy. Mm-hmm. I mean, Tom, you've been doing this 15 years now. Maybe just speak to that point. How are buildings performing, and how do you think buildings are going to perform over the next 12 months? And if you want to talk specific areas or product that you're involved in, feel free to get a little specific and help everybody understand exactly what you see happening.
So multifamily, I think investors are pivoting and taking a firmer stance on operations, where in the last couple of years they've been looking to grow their portfolio. Now they're really seeing how they can make what they have work. And I think that's going to be the case for probably the next year or so, I would say. But overall, I think operations it's not too far off what we've seen. Expenses are coming up a little bit. Other than that, I think operations are doing pretty well.
You have a lot of conversations with owners that are optimizing their current portfolio. Maybe a great question for both you guys, and Tom, I'll go to you first since you just answered. But what are you seeing? For an owner who has one or two buildings, maybe they don't have 400 doors under management. What are some of the things that larger owners are doing to make their current buildings operate more efficiently that a smaller owner might be able to apply to their portfolio?
I mean, a big one that some of the bigger clients are using, they're implementing RUBS type systems on their buildings, which basically bills back utilities to the tenants. And that can be huge, especially when you're in a city like Los Angeles, where I sell a lot of apartment buildings. The LA DWP, they've gone up tremendously. So I think if you can focus on little things like that, it'll make a big difference.
Trash is always a favorite one for owners in LA to be complaining about as the bill goes higher.
Exactly.
Mike, that same question. You work with a lot of owners that have multiple properties in Orange County. What are some of the things that you're seeing that they're doing to optimize operations right now and increase their own NOI?
What I'm noticing the most in Orange County is owners giving the maximum allowable rent increase under AB 1482 rent control. There's a shortage of working class housing in Orange County. So a lot of the times you can give that 10% increase and tenants pay it. They don't want to move out and have to go to Riverside or San Bernardino. They'd rather pay that 10% bump. So I'm seeing a lot of people doing that, especially noticing that cities like Santa Ana have introduced city-specific rent control ordinances, and there's a school of thought that will end up spreading to some of the other bluer cities in Orange County. Perhaps Garden Grove and Anaheim might look at something like that. I know there were some headlines about Buena Park. City Council looking at city-specific rent control ordinance. So getting the 10% rent increases in now while you're allowed to is one of the ways owners are boosting NOI.
Let's talk about that for a second, guys. We're starting to see headlines about rents flattening, certainly in the higher quality product. CoStar's charts and graphs are talking about flattening rents and increasing vacancy. But speak more specifically about, are you seeing landlords increasing rent on existing tenants, and how many are really leaving if they get a rent increase right now? You want to take that one first? You kind of covered it a second ago, but maybe go into a little more detail.
Sure. So a lot of owners that we work with are in the private client space. They own a portfolio of small buildings around Orange County, and a lot of times they're operating the buildings in a way that's just comfortable. They're making more than they've ever made before on the assets, and so they've maybe not raised rents at every opportunity that they've had. So recently, with inflation and everything going on, a lot of them have taken the opportunity to give a rent increase. And a lot of times, I just spoke with an owner the other day. They gave a rent increase across the board on a 10-unit building. They didn't have one peep out of the tenants. Everyone was fine with it and happy to stay. So.
They haven't had it in so long, they probably expect it more times than not.
Yeah.
And just a reminder for everybody that's joining us, if you've got a question, type it in the chat. We'll get to it over the course of the hour. But feel free to write them there, and we'll try to get to them as quickly as we can. Tom, comments that you're seeing in LA as it relates to in LA County, I mean, not just LA City, although I know you got a ton of focus there, about landlord ability. Like, what is a landlord able to do right now as it relates to rent in LA County and then LA City specifically?
LA County, it's similar to what he's saying. There are rent increases going out and tenants are staying. LA City's kind of a different animal. We're still kind of frozen. However, there's a lot of very aggressive buyers who are buying really good deals right now, and they have that money, that cushion to kind of cash for keys. So there's a lot of that going on with the more aggressive buyers.
This question is obviously going to depend on type of unit product or type of unit location, all that stuff. But what are some of the cash for keys numbers you've been hearing? Kind of highs and lows.
20 to 30,
Okay.
I would say.
Going back to real estate headlines that are clickbait, I'll give the one that I think I hear most often is that the real estate market is bad. And I think what I would say, somebody who's been doing this a little bit, is the market's definitely changed, and chasing 3 caps with 3% interest rates is no longer what we're seeing in the marketplace. But the market is awesome for people who believe any or all of the 3 following things. 1, that rates will someday come back down. 2, that rents will go up. And 3, that prices will go up. If you believe any of those, you can buy properties today at 20 or 30% off and refi as soon as rates get better, or 1031 exchange into better property. We're going to show you a slide right now that shows multifamily activity in LA and Orange County between 2010 and 2013. Rates had gone up, liquidity was hard to come by. Most people were sitting on the sidelines. You can see from the chart, we've got one owner highlighted in green who bought over $160 million worth of property and currently has, if you can see the map, that's 79 properties in LA. So what we saw a lot of at that time was that the biggest owners or owners that have built a really big portfolio in the last cycle utilized this time to buy property and acquire a bunch of units that they believed in the near term, 5 to 7 years, we're going to come back to previous highs and exceed that. Tom, you've been in the business 15 plus years. You take a look at that list. You talk a little bit about how many recognizable names you see or that, we talk to on a regular basis.
I was just going to say, it's funny because I'm going through the comps the other day and all these same names are coming up. So I think they know what's going on. They've seen it before and they're getting good deals right now.
Yeah, it's really, interest rates are higher, but one of the easy ways to make money on a piece of real estate is buy it when interest rates are high.
Right.
And we've got a bit of rent catch up from COVID and the pause across all product types that's going to get caught up here in the next few years. It kind of do that little bit of interest rate drop, and all of a sudden a property that you bought in the next 3 months might be the best buy you ever make. But let's talk about that, you guys. The deals are getting done. I think we're seeing across our inventory what it takes to get a deal done and what it takes for something to just kind of sit and be stale. But when deals are getting done, it's taking longer. Mm-hmm. Let's talk a little bit about just expectations as people enter the market, both as they look at that slide, they hear what we say, and they're like, I got to jump back in and start writing offers. What should they expect on timing for deals, and why are they taking longer? Tom, you want to make a few comments first?
Well, I think both buyers and lenders are very selective when they're looking at their due diligence. Before, it's almost kind of like blind underwriting, people call it. Now they're really digging in, especially banks, because it is tighter. Operations are tighter, and banks have been a little more timid recently.
Yeah, banks certainly have changed their aggressiveness. I mean, we've seen a couple bank failures, probably particular reasons for each one of those, not a systemic problem. But when those things happen, lenders get cautious. Mike, you had some additional comments to that question. It's what's caused deals to take longer?
Yeah, I think it comes down to accurately pricing property based on the current interest rate environment and also the alternative investment choices that people have. So I see a lot of sellers still chasing yesterday's price, high 5 to low 6% interest rates eat up the cash flow on a lot of apartment deals. And so a lot of people are, the objection that I hear all the time is, high interest rate savings accounts and 3-month treasury bills at 5.2%. are giving people choices on where to put their money right now. So I think right now you have to be the best priced property on the market to move quickly. And if you are priced accurately and correctly from the beginning, we're still getting multiple offers on deals and closing them quickly. But there's just people out there who have kind of overshot the runway with their initial pricing. And so it's takes time, and it's a bit of a process to until they meet the market, I'll say.
And as we go on today in this conversation, I'll let you guys talk about some of the deals that you've done lately that have had 5, 7, 10 different offers, because I think it speaks to there is appetite out there. It's just maybe a little bit more cautious. I mean, you look at with the lending environment, I mean, we know rates are higher. You both have already mentioned higher expenses and tighter underwriting from lenders. You couple those two things, and a buyer has got to put more down to acquire the property today, which anytime in that situation, people are a little more cautious. They want to make sure they're making the right investment. And then perhaps, I thought we were joined by Michael Dirk of Marcus & Millichap Capital a couple of weeks ago on our sales meeting. And I thought one of the most insightful things that Michael was talking about as it related to lender tightening was qualifying of the sponsor and the requirements that they were putting on the borrower, in addition to the property specific rate and terms.
More deposits.
More, higher quality, more experience, all those things. It was just diminishing the pool of competing lenders. Which kind of leads me to the next question, which I think is an opportunity for both sellers and buyers to do more transactions right now, is talk a little bit about, are you guys seeing more seller carry in the market? As we get to where a seller can carry a loan at 5 to 6%, that return usually more than what they're getting on the property today from a cash flow perspective for that seller. They get a little bit of money. In the best case scenario, or in the good case scenario, they get a consistent payment for a good period of time and don't have to do any work. And maybe in the best case scenario, they get their property back at 50 to 70 cents on the dollar. Talk a little bit about that. Are you seeing that? Are you starting to write more offers with seller carry?
I can tell you that the first question I ask when I'm looking at a deal from another agent is the owner willing to carry? It's just become a part of every conversation because it'll make deals so much easier. And sometimes it does make sense for a seller's exit strategy.
And even Tom, maybe talk for a second about the Redondo Beach deal, where the seller is seeing maybe the opportunity to get a good return by carrying.
Right. And
how it really kind of changes the opportunity in that deal for somebody, because they probably got a little bit more flexible, on your team lender to do what they need to do to work that project.
Well, they don't have debt. They don't have any debt on the property. And if they did carry, doing the numbers, they would make twice as much money as the income is producing right now. So it makes sense for some people in some situations.
And maybe talk about in that deal benefits to the buyer because they are willing to carry, what it can give them from a flexibility of, working through the process, money up front, all those sort of things that might make a deal more attractive.
Yeah, well, it's always a lot easier when a bank's not involved, especially right now when banks are, like we said, a little timid. So it opens up the buyer pool. A development deal, you might have to put down on this deal in particular, probably 70, 80% right now. And if you can leverage 60%, it's going to open up the buyer pool.
Mike, comments of what you're seeing on seller carry?
Yeah, we're seeing a lot more seller carry deals. We actually just closed a deal in Pomona last week. That was a seller carry deal at 5% interest only for 5 years. So compared to conventional financing, that's going to be probably 5.9 to 6.2% for a 5-year fixed right now for conventional apartment debt. It was attractive for the buyer. It made the whole process way easier. He was able to close really quickly, and the seller can get a decent return as well. So it's kind of a win-win for everyone.
Yeah, I think we're going to start seeing it a lot more. It's going to facilitate some transactions, and it really can create a win-win opportunity for people that they want their return, but they're tired of the work. Maybe they can make, maybe a seller who had a partnership with tenants and didn't raise rents or whatever can make a little bit more money and do nothing, and still, delay the tax payment, until the loan gets paid off.
Right.
Let's turn to another question and kind of headlines and what we're seeing out there. We certainly are seeing all the reasons people aren't doing things or the trouble out there, but what are opportunities are people missing out on right now?
I think the cap rates on some of these triple net deals is something we haven't seen in years, and I think it's going to be a small window to capitalize on them. So I really like the triple nets, especially with a strong tenant, strong lease. That's my answer.
I'll make a quick comment on that. I mean, I think we've seen cap rates push up 100 basis points, maybe even 150 on some tenants. There's probably still a little bit more room in those. And, when people buy a net lease property, at least over the last, 5-6 years, it's really just a cash flow, capital preservation, high security, safe sort of deal.
Right.
There's actually going to be some appreciation.
Yeah.
In these things when rates do go back down, when returns get more competitive and lower, where somebody's going to get a nice little bump in these. Mike, you got any comments on Tom's observation about net lease? And then tell us what you think is maybe the.
I've totally noticed the exact same thing about net lease deals and the returns being much higher and being able to get a quality tenant like a Taco Bell or a Starbucks at a 5 cap or better, which I think is pretty cool. The opportunity that I've kind of noticed the most is being able to get properties at a much lower cost basis than you could have 1 or 2 years ago. So I was at an apartment building in Orange County just yesterday. We were doing a little walk around the exterior, and we were showing the buyer a comp from last year that was a really similar building, same unit mix, right across the street, had sold 1 year prior for $100,000 per door more. So this one's being offered at $100,000 less per unit for the exact same building, basically, that sold right across the street a year ago. And to me, I thought that was pretty cool. I think a lot of people would rather have a lower cost basis because that's something you can't change. And maybe the financing, maybe the interest rate's a little higher, but you can refi down the line. So the financing is changeable. The cost basis isn't. Being able to get a low cost basis right now, I think it's pretty cool.
Real quick question. Are the rents in the current building higher today than when that traded for 100,000 more? Like, have rents gone up in that neighborhood?
The rents are significantly higher. The cap rate is probably 40 basis points higher on the deal that's $100,000 less per unit than the one across the street. So seems enticing to me.
That's going to lead me, segue me right into the slide that you have up on the screen. What do I think is the biggest opportunity people are missing out on? It's doing exchanges today. Mm-hmm. When the market's great and it's hot and it's going up, exchanges usually work and exchanges are successful. When the market's going up, you buy at a higher price point, cost basis, as Mike just mentioned, than you sell. And they still do great. Now is the opportunity in the window when you're actually going to buy at a lower price point. Tom and I did a bunch of business in 2010, 11, 12, where we helped longtime owners significantly improve their situations. Mm-hmm. Whether it was they were in a little bit of a dicey area and they could make the same amount of money year one in a much better area, and in year 5, increase their cash flow by 40 or 50%. Or they had an older building and they got a newer building or whatever it was. when there was a lot less competition and prices were going down, they made some of the most profitable exchanges. On the screen, you'll see one of the best ones we did. That top property was a 1960s construction building, 30 units, mostly studios. They'd owned it for 25 years. It was 15 minutes from their house. And it had been a great property. They ended up doing an exchange because they were starting to spend a little bit more time at their beach house. They didn't like having all studios, and they were really getting annoyed with the cost of the elevator repair in their building because the elevator was 45, 50 years old at that point.
They're expensive.
They are not cheap. And the top building was in LA. So they had some rent control issues at the time. The bottom property is 40 plus units in East Side Costa Mesa in Orange County, which is a top submarket in all of Orange County and all of Southern California when it comes to apartments. The building was newer. The building sits on a huge lot. They made an additional $4 million over the last 10 years by doing the trade. They did the trade in 2011. Interest rates had gone up significantly. Tons of people were sitting on the sidelines. Everybody was still unsure which way things were going. There was still a lot of speculation that we were going to see this return of the REO market like the 90s. And this isn't one of your, top 10 buyers in a period. This is a 2-building, maybe 45 unit owner who did the exchange that significantly improved everything about their portfolio by doing an exchange when everybody else was sitting on the sidelines. And to think what they got to pick and choose from, knowing, yes, they bought this one, but not the ones that they didn't buy, compared to maybe having fewer things to choose from because of more competition had they done it at a different time in the market.
Right.
Talk about an easy exchange. One of the easiest, most profitable ones we've ever done. The next thing that I talk about on the other, I would say, opportunity that people are missing out on is opportunity zones. They don't work for everybody. They are not just a real estate sort of exchange transaction, but they are a utilize the tax code to your financial benefit real estate transaction. And if anybody has had some sort of capital event, sale of a business, sale of a Picasso, sell a first pair of Air Jordans, you name it, whatever it may be, significant capital event. If they haven't explored every option in opportunity zones, they are missing out.
Mm-hmm.
Get the ability to defer tax now. You basically use the money you'd pay the government to make money for the next few years, and then avoid all gain and depreciation recapture if you hold it 10 years. And people can get new construction buildings. They can get apartments. They can get single tenant. They can buy them individually. They don't have to just fund basically a DST or a hotel development. There are so many opportunities in opportunity zones. And we've been doing a number of these, and everybody that, when somebody gets one done, they love the tax benefit. Their accountants love the tax benefit. Their attorneys check all the boxes that it's something they can do to get all those benefits. The opportunity zone thing was one of the few bits of legislation that both Democrats and Republicans agreed on during the Trump administration. There's that much support behind it. And so I think opportunity zones have been really a great opportunity for clients, but and something for anybody to explore as a capital event. And we've got a great team at Centennial that can help you do that. Guys, our next question, maybe, or news headline. Is the office to residential conversion the savior of office vacancy and the housing shortage in California? What are your thoughts?
I think it's not one size fits all, but it's certainly going to help in different areas of the country. What's the term that I heard? We're not overbuilt, we're under demolished when it comes to office buildings, which I think is it's true. There needs to be some repurposing of these buildings. They're huge. They take up a lot of land. So
Yeah, we're starting to hear more people come back to the office, and more companies requiring it. There's certainly a lot of grumbling and pushback. But the one thing that for office, let's call it occupancy, that it has in its favor is that the further we get away from COVID, there's a lot of people that will be entering the workforce that never got to work from home for 2 years.
right.
And be in their jammies and, sit at the computer. So that expectation, I think, will get some people back in the office. But yeah, I think to Tom's point, there's a lot of office out there. Now, Tom, I'll share some numbers that I heard, or at least some concerns that I heard about that in a minute. But have you heard anything as it relates to costs of actually doing this? There's these big, beautiful buildings that, when you look at them, you go, well, that could be a 10-story apartment building with these amazing views. Is it as easy as everybody kind of thinks it might be on the surface to make these things housing?
I don't think so. A lot of these buildings, they don't have windows that open, and that's a big cost. You've got to put bathrooms in every unit, so it depends on the building, obviously, but it's not easy. It's pretty specific and it's pretty specialized, but people are making it happen.
Yeah, I read an article that said it basically said that converting office buildings into multifamily in the past 20 years has only accounted for 1% of multifamily deliveries. So I don't think it's as prevalent as maybe the headlines make it seem. I think it's definitely cost prohibitive, and the regulations make it difficult. Reworking plumbing, electrical, HVAC, all that stuff is super expensive. So I think in a lot of cases, people are figuring it might be better to just start from scratch.
Yeah, it was interesting. I had a conversation with a leading architecture firm here in Southern California, and we were talking about office buildings on Century Boulevard by LAX, right? Like the 50s, 60s office buildings, probably, half to 75% vacant now, older, and it wasn't a one size fits all thing to everything that you just mentioned, Mike. Like getting all the electrical in, the demand for electrical, the load, the plumbing,
the ceiling heights. I mean, there's a lot that goes into.
There's all kinds of things
right
to figuring out if a building is it's cost effective to do it. I mean, you could do it in every building. It's just, is it cost effective, or is it better to knock it down, start from scratch maybe, or get it occupied as an office building? So I tend to think that, yeah, we'll see it in limited cases, but we're not going to see it in every building that has a little bit of vacancy right now.
The footprints that some of those buildings are on too, especially in Orange County, like with the surface parking, like you're on acres of land and you can build significant housing on that. So I think it's an opportunity for somebody, and I think it's going to become more prevalent, definitely.
Yeah. Let's talk a little bit about, you both have had a ton of success helping clients tap into opportunities, outside of a 15 or 30-minute drive from their house. And as somebody who's a little bit older than both of you, when I got into the business, I had to be able to drive it, was what I heard all the time. And it was different. There wasn't the internet. Just communication wasn't as like it was definitely harder to own and operate a building further away, whether it's further away in California or out of state. How are some of your clients following, let's call it, the exodus of business out of California to these emerging markets that have better growth numbers than California, and still effectively managing their properties?
I think the easy answer is invest in a triple net lease deal out of state with no management or maintenance responsibilities. So that's what some people are doing who want their investment to be more passive. For people who still want to grow their portfolios, we have done a number of out-of-state apartment deals where we actually fly out, and when we do the inspection and the appraisal and take all those steps, in the deal process, we actually interview management companies for them and help them choose just a rock star manager who's going to help increase revenue, minimize expenses, and get the building operating more efficiently. So I think on every out-of-state apartment deal we've done, we've ended up finding a really good manager to take care of the day-to-day.
Talk a little bit about South Carolina transaction. If I remember that one correctly, rents were at X. We went out, we interviewed a couple different management people, moved away from who had been the management company for the previous owner, put somebody new in there who might be one of those rock stars, and where she got those rents down.
Yeah, so we did an out-of-state deal in South Carolina, 38 units, all 3-bed, 2-bath townhomes. It was 2012 construction, all single story, so kind of like having your own individual little home. And the rents were around $800 to $900 per month per unit, which we knew was low. And we hired a property manager who managed about 500 units in the area and who was super aggressive on raising rents at the other properties and was able to kind of show us a track record of success. And we know all the right we know the right questions to ask. So
And the answers.
and the answers. And she ended up getting rents from $800 or $900 a month to $1,100 or $1,200 a month on about 25% of the units in the first 6 months, which was pretty cool. I mean, they were already buying a 6 cap deal, but I think it was closer to a 7 cap after the first 6 months.
That's fantastic. That's 3,000 miles away. Tom, you've done a lot of business in Vegas with a lot of people that are still Southern California based.
Mm-hmm.
How do they do it?
It's the same thing. We know the right property managers to hook them up with. And when we're out there doing our due diligence, that's just part of the process, is meeting with them. So it's not rocket science, and we know how to do it, like you said.
And I think the big part is just it's doing the due diligence the way that you would if it was around the corner. I've heard the stories of people buying net lease properties, sight unseen or taking it for granted, or it's an 11 cap and I'm going to just hire the management company that is already there. And oftentimes those things sound way too good to be true. And one of the things
I'm still not sure about.
Siri's not so sure that those are good deals. But one of the things that I think is what we do well, or what's one of our core things, is like, it doesn't matter whether it's in Alaska or Maine or Key West or Santa Ana or Long Beach or LA. Like, we got to go see it.
Yeah.
We got to really see it. Yeah, it's not necessarily our money, but we want to look at it like it is, and it's our job to go see it and look at it. And I know that both of you have gotten on planes and gone to places, and within 5 minutes been like, you can't do this.
Yeah.
Like, this is just the wrong deal, because it's not everything it was cracked up to be, and it's okay. We're gonna go find another. But doing that due diligence and going and looking at the property and spending some time, whether it's you're buying a quick service restaurant and you grab something to eat at 11:30 and you sit in the restaurant from 12 to 1 and count the cars and all that stuff, or figure out where the schools are at if it's a convenience store and things like that. All those things that we do when we're out there to make sure that we do all the same stuff we do as if it was around the corner.
And if it's our own property.
Yeah.
I mean, most of us own properties, so we know what to look for, which kind of sets us apart from other brokers, I would say.
So since we do own properties, and certainly we work with a lot of owners, let's talk about just some of the things that people might not be seeing yet, or maybe it's on their bill, but it's not big enough yet. What are some of the expenses that have gone up significantly for owners?
I think insurance, we hit on this earlier. City of LA, the Department of Water and Power has gone up significantly. I think it has, all across California, but City of LA really bad?
Insurance is the one I hear from everyone. I mean, State Farm and Allstate are not writing new homeowners policies in California right now.
Right.
And I've got a few different phone calls from owners of apartment complexes here in Orange County that said their insurance companies dropped them, and they were asking me who they could call to get a new insurance policy. So in some cases, I've seen insurance go up 20-30% for some owners, and it's a big cost.
Yeah, I feel like probably in the last month you've had 3 or 4 people that don't have insurance because they can't find anybody that'll give it to them, or it's not easy for them to find somebody that'll give it to them, and they're calling you to try to figure out who do we know that can actually help them and get them covered.
Yeah, and luckily we have someone who's really good, who's been able to get all those people covered. But it's just been interesting getting those calls. It's something that we haven't really dealt with in past years before.
Yeah, I think on the multifamily side, we used to budget 25 to maybe 35 cents a foot,
Right.
And now 50 cents, 65 cents.
I'm doing 60, 65.
Really, just in the last year. In addition to water insurance, anything else that you guys are seeing? Everybody used to say that you're going to redo a bathroom and a kitchen and a unit. It was going to cost you, 10 to 12 grand.
Yeah.
Where are we hearing numbers come in on stuff like that right now?
30 to 40.
Yeah, I think the days of redoing a 1-bedroom apartment for $10,000 or $15,000 are maybe gone. Unless you have a crew that's doing all the work yourself and you're a contractor, I'm seeing $25,000, $30,000 for a lot of them.
Let's talk about retail for a second. You guys both have mentioned some single tenant stuff, and probably both of your practice is on the multifamily side. You certainly do some retail stuff for people. 2-3 years ago, the death of retail. It was between Amazon and COVID, it was dead. And maybe one of the real estate headlines that's not clickbait is that how well retail is recovered, maybe better than expected. Why do you guys think that is? What's the change that you're seeing?
I think a huge part of it is experiential retail. People want to get outside, go out of the house, have fun. So that experiential retail is done super well after COVID.
I think people are just confident to go out and shop. I mean, it seems like the viruses are under control. The mask mandates are gone. People were afraid to leave their house. Now they're actually going out and shopping again. So that's a big part of it.
Yeah, I think it's really interesting right now. We've got, as a firm, a listing in the east side of Long Beach, which is a very, very suburban market. Good sized property, little north of 20 million. That's a mixture of long-term triple net lease with IHOP, couple other restaurants, and then a bunch of medical tenants. And 15-20 years ago, that wasn't the makeup of the property. But when you look through the rent roll and the collections, those restaurants and these medical tenants, nobody ever leaves.
Right.
And they've all got decent rent increases built in there. And this is there's probably 3 dentists, maybe 4 in the property, and they're all packed all the time. I mean, we're fortunate enough to share the space or to use a little bit of an office there, so we get to see the property every day. But when you're there every day, at some point the parking lot's always packed. The restaurants, it's crazy the line that you can see out of IHOP or at Kennedy's and on an afternoon for some drinks and a game. Like, people are standing, almost outside the restaurant having a beer. And then they've got these great medical tenants. It seems like, yes, people certainly want to get out more and do stuff, but retail's just changed. It's gone, the user of retail is now a service or an experience, whether it's nails or tutoring or athletic training or a restaurant or an escape room or something that you go to have something happen, not just buy a product.
Yeah.
Certainly, Tom was talking about being in Las Vegas today, and I was out in Apple Valley, and there's certainly plenty of warehouses that are shipping T-shirts and all this baseball gloves and all the stuff that you used to go buy in a store.
Mm-hmm.
But you really the switch to and those tenants that are doing fantastic and what used to be let's call it brick and mortar retail is now brick and mortar service or something like that.
Right. Yeah, I think that during the pandemic, a lot of these businesses, they restructured their operation and the way that they do business. Like there's a lot more drive-throughs now because people aren't hanging out in restaurants. Concepts are different. So it was brutal to go through, but I think it helped on the back end.
It's interesting you say that. Like one of the things that I've noticed, and this is maybe more of a single tenant thing than just a retail center, but it's how multiple different segments now are all kind of trying to use the same footprint.
Mm-hmm.
Like the brand new construction bank is the same size as the brand new construction fast food with not as many tables on the inside.
Right.
Which is about the same square footage and layout as the urgent care. And so you got these three totally different uses, but all kind of using the same footprint, which leads those properties to have more potential tenants when they have the ability to increase rent and get competition.
I agree.
Let's transition a little bit. We've talked a little bit about some of the headlines, what we're seeing in the market. But let's talk about some of the deals that are out there. And before we talk specifically about a deal, Mike, I think you mentioned it earlier. Guys, talk for a second about, are there buyers out there? Or is everybody just sitting on the sideline? Because I think in my position, I see that for some properties, we've got as much appetite and enthusiasm at whatever you would call the peak of the market.
Mm-hmm.
Make some comments on that.
Well, it's all about pricing, and you're right. I missed out on a deal that ended up having 10 offers on it. It was a well-located strip center with upside. I had a really strong buyer. We came in $400,000 over list price, and we missed the deal because it's priced right, and the seller was selling. So there's deals going down, absolutely, and there's still buyers.
Yeah, we have a property we just listed on Brookhurst Street in Huntington Beach, about a mile from PCH. We already have 5 offers on it. We have threats of a few more offers, some buyers circling. So, I think that deal is going to a best and final, and we're going to select a few of the best parties to get inside all the units, do their inspection, and see who comes back at the highest price and most favorable terms without contingencies. So kind of the same as we were seeing when interest rates were low, because it's priced correctly for the market.
I'll ask you guys a question. I want you to pretend for a second that there's no way you're going to make a commission. It's a totally different product than what you do. And you meet somebody or somebody calls you up and go, hey, my friend said to give you a call. I'm going to be selling a property. I just inherited it, or we've owned it for 20 years and we haven't been in the market. What's the best way to price it today?
I think the best way to price it is price it so that it's the best deal in the area. You can't be the 5th best deal or the 10th best deal and hope that the market catches it. It's just not going to happen. It's going to end up sitting out there. Days on market's going to be really long. It's going to be stagnant and it's not going to sell. You have to price it so that it's the best deal in the area. It's really attractive, and you end up getting a bunch of buyers to compete on it and end up driving the price up and netting the seller the best terms that let them accomplish their goal really quickly. That's what I would advise.
All right. Tom, what about when somebody goes, yeah, but everybody's just going to, every buyer's going to not offer their best. They're going to grind me down. I need to be at a higher price.
Well, it comes down to deal stories. I just had one where we had 12 offers on a property and it went way above list price. So that's not true. And if you know those stories in those comps and you're able to tell the client exactly how and why it happened, that's how you're going to have to get it done.
And you guys have both talked about price and terms, but maybe focused on what was driving the price. I'll make the comment of terms and performance,
Right.
and also how the pricing strategies that you guys are suggesting gets that. The last thing we want for clients, I mean, we've talked about it. We think that the market is going to maybe continue to go down in a price standpoint for a little bit, and we think that's a great time to exchange. So I'm not going to change what I say here about where the market's going, but what we're seeing is on the properties that get maybe one offer, is the seller's at a lot more of the mercy of the buyer. And it usually means longer due diligence periods. It usually means longer until deposits are released. And it also means longer time the buyer is trying to find a better deal.
Right.
And the worst thing that can happen is trying to start the deal again and go back to the market and get second and third waves of offers. I mean, I feel like it's like starting a race in quicksand. Like, it's just hard to get back there because the buyers that were the most aggressive or whatever. But I think that in that competition, we're also, not only is it driving price and maximizing price, whatever that is, but it forces buyers to do the best they can for the seller. And it increases closing probabilities, which is probably more valuable than, even a little bit extra money is getting it done if that's what somebody wants to do right now.
Yeah. Getting it done the first time too. It's utterly important.
Yeah, Justin, I'll tell a quick story. We just closed a deal in Anaheim about a month ago, and there were 3 different groups that came back after the best and final with no contingencies. And so the seller knew if they choose one of these buyers, it's a done deal, and they don't have to worry about getting tied up for 30 or 45 days and then having a buyer not perform and having to go back to market. So I think you're right. The super short contingencies is really attractive right now. So people know that they're only going to have to sell it once.
Yeah. In the Long Beach office, one of our guys got, I think, 7 offers going right now on an industrial building. And it's been interesting as the offers rolled in. This is our best. This is all we can do. As offers have rolled in and there's competition and there's people that were telling, hey, you made a really good effort, but you're probably going to lose this thing. Down payments going up, deposits going up, due diligence period shortening, deposit releases. We were told absolutely there is no way my buyer will release any of their deposit. And yesterday they were like, well, we'll release 25 after the removal of the physical inspection. And it's all because good property is attractive. You guys just said it. And people don't want to lose good property because when it is priced right, there's not much that is attractive today. There's still a lot of 2 caps with upside to 3 caps and financing at 6.
Right.
And nobody's going to buy that right now.
Right.
And so a well-priced property, certainly it has a captive audience and the attention of the masses. As we wrap this thing up, guys, you got a deal that you can't believe is still sitting on the market that you want to talk about or share because somebody's going to do really well with it and it's going to help a seller by getting it sold, and the buyer who buys it's going to have a really good investment going forward.
Go ahead.
Yeah. So I just listed 8 units in Paramount, 7224 Walnut Avenue. It's 8 units, all 2-bed, 1 bath on a really large 15,700 square foot lot. What I like the most about it is that it's on a street with all single family homes down the entire street for a couple of blocks until you get to the end of this quiet cul-de-sac. And at the end of the cul-de-sac is this one multifamily property. So it's the only multifamily deal in the whole neighborhood. And so it's a super safe location, tons of parking. They have a lot of outdoor space, private yards, balconies, things that people can charge a lot more for. And the ownership group, a couple of them live out of state. They're going their separate ways. And they haven't really raised rents much over the years. So there's just a ton of upside in rents. Average rent for these 2-bedroom units is probably $1,450 currently. I've been looking at other properties in the area In denser apartment neighborhoods that are significantly worse locations, they're getting 2,200 for the same units. I think there's something special here because of its location, on a single family residential street, backing up to an equestrian center. I think someone's going to do really well with the property. I think they're going to get it operating above a 6% cap rate. So I'd recommend checking that one out. 7224 Walnut Ave.
And it sounds like one of those deals. It's not an overnight. In 6 months, they're going to put it back on the market at a high. It's going to take a little bit longer, but that's not bad. Like, and taking a little bit longer when you're in a good neighborhood. And I think Tom and I sold a deal over by there 10 or 11 years ago that we thought that part of that pocket was nice, but knowing where this one's at is actually even a little bit better.
Right.
But yeah, that is the right property for somebody who's over time gonna gradually, one tenant, maybe two tenants at a time, get those rents up and have a building at market that's gonna be a really nice return. Tom, what about you?
I've got a little different deal. It's in Redondo Beach. It's a covered land play. The location is phenomenal. It's on PCH across the street from Whole Foods, which is awesome. It's 24,000 square feet, which is really hard to come by. It's zoned commercial. We're priced at $5,150,000, which price per square foot of land comes down to $215 a foot. It's probably deliverable a little under that. We've got some good activity. Seller has recently said that he would consider carrying financing. So that's kind of what's going to push this deal over the edge. But just a well-located property that people are going to want to own and can get a good deal right now.
It's one of those pieces of property where it's an awesome location. The location is always going to be awesome.
Right.
It's maybe super underutilized or under maximized right now. But somebody with a little bit of vision who parks the money there maybe in the short term as they work through some planning to get the right thing on it is going to have either a property that's worth a lot more in a pretty short period of time, or a family's never going to sell it.
Right.
You'll
want to own that deal in 10 years.
Yes.
I can promise you that. Somebody's going to get a good deal.
It is a really well located property. You had mentioned before we started that you were talking about being in Vegas today.
Yep.
You want to share a little bit about that story?
Yeah, it's not a listing. It's a former client. It's a 24-unit apartment building at the numbers using a 5% factor for management, 2% for on-site. The numbers day one it's a 7 cap going in. It's right off the strip behind a very big hotel that everybody would know. Just a phenomenal location. Good deal. So if anybody's in an exchange or interested in Vegas, please reach out.
Last thing, I think we got probably 2 minutes. Tom, talk a little bit about LA. We've seen ULI pass this year.
Mm-hmm.
We've got for now proposals requiring AC in all units, and I saw something the other day that on a 8-unit apartment building that means $25,000 to $50,000 in electrical upgrades, because we've all been in those units that now that people have computers and whatnot, they're frying, blowing fuses all the time. And then, probably another 15 to 30 just for the actual units. We got the balcony thing coming in 2025. Where's the positive for LA owners?
The positive is it is still California. People are always going to live here. There's some better buildings, but it's been pretty rough, and it seems like it's going to be rough for a couple more years at least. So people are sick of it, and they're making decisions to move their equity.
It's been interesting. I mean, I think there's some people, and we can probably make the list of some of the largest owners in LA have maybe now moved their equity to outside of LA over the last 3 to 4 to 5 years, or at least a good portion of their portfolio. But I think a lot of the mom and pops are kind of behind the curve on that one.
Yeah, I agree.
It's a little bit burying head in the sand. You know what? It's still better than it was. I'm making more money than I was 5 years ago. Well, Problem is that you have a lot more equity,
Right.
and it's getting a lot harder, and you got to do a lot more work to get that little bit more. And there might be greener pastures someplace, and the opportunities are there. I'd like to thank you both for joining me, and pinch hitting for Jason Brooks, who's one of our favorites and is a great contributor to all of our business as he was out today. I thought your comments were really insightful. If you want to reach out to Mike Alper or Tom Watkins, please call us here at Centennial. You guys want to talk about maybe cell phone number or how somebody gets a hold of you if they got a question about some of those areas that you specialize in. We'll also put it in the chat, but you want to share it?
310-488-1789. That's my cell phone.
My cell is 310-713-2589. Give me a call anytime.
We'd like to thank you for joining us today. We'll be back in a few weeks talking about the things that affect the commercial real estate market and affect our clients' returns. And thank you all for joining us. Have a wonderful day.